Welcome back to Tip TV Finance. My name's Charlie Burton. Last time I was on the show, I interviewed John Mattingley. He was so interesting and we had to get him back on because he spoke so much we run out of time. John, welcome back to the show.
Thank you, Charlie.
So John, last time we were speaking, we were talking about the city and things that go on at financial institutions. Maybe we should kick things off from there and talk about market manipulation.
Yeah.
So I mean, a lot of traders out there, let's just expand on this first of all, think that the markets are heavily manipulated and that the markets are, or financial institutions are out there to run their stops and all that sort of stuff. What's your views on stop running and general manipulation in relation to the average retail trader?
Yeah, there is that sort of understanding or I say misconception by retail traders that somehow or another the market is out there to get them, and that somebody in a bank saw their small one tiny micro trade go through and decided to run their stops. That doesn't happen. Banks in particular are dealing with client flow. Particularly, and we talk about FX here, but it applies to equities and indices as well. But typically they're talking about client flow that's going through. As much less proprietary trading goes on these days than used to. So actually, as a retail trader, you can be more confident that any kind of market manipulation, and we're using, for the purposes of this, retail traders tend to use market manipulation as a pejorative term. But the fact of the matter is market manipulation is happening all the time. Even when if you put through one of your micro lots, you are perforce manipulating the market. It has an effect on the market, however small. And it's the accumulations of those that you see in the marketplace. Now, if you're a bank, and there are about 10 of these guys who can kind of push this market around if they wanted to in concert, but they don't because they're chasing each other. But what happens is they have a different view of the market to what we have as a trader. We have a lot of flexibility. We can get up in the morning and we can get up at 5:30, or we can get up at 7:30 or 8:30 or even 10:30 in the morning and look at the market and say, oh, shall I put on a trade? What does it look like to me? They can't do that. It's not shall I put on a trade, it's where can I put on a trade, because they're not dealing with the micro lots or even the bigger ones that we deal with. They're dealing with absolutely huge amounts of numbers. Those numbers translate into market movements, not easily but relatively easily. So what they have to do is look at where they can actually place those trades. What that inevitably leads up to is a kind of confluence or a funneling of those trades into the marketplace by banks. They're iceberging them, which means they break them up into smaller numbers, and then you see the cumulative effect of that being a spike in the trading day. That does not mean that they are running your numbers. That does not mean that they're actually manipulating the market. However, for the purposes of being able to conceptualize that and to be able to explain to ourselves what's happening, this term manipulation has become current. It did, I think also as retail traders, as independent traders, we are removed from what's actually happening in these banks, and we only read what's happening in the newspapers. Unless you've been on the inside and looked at the inside, fortunately I've seen some of that, you don't realize that actually the manipulation is not there. On the positive side, if that manipulation weren't there, none of us would have anything to do. The market would be flat. So we've got to be grateful for the fact that they're actually doing that to some degree. So that's what I think the takeaway is retail traders shouldn't be frightened of that. If they see stop runs going on, as long as they're looking at the price action, as long as they know where their support and resistance is, as long as they have an independent view of what's happening, as long as they know what their trading method is, that's not something to be frightened of. And certainly nobody's out there saying, you, John Mattingley, have just put through that tiny little trade and I'm going to knock your stop out. That doesn't happen. They don't even know you exist.
Good. Okay. Hopefully that helps with some of the retail traders out there and their views. I just looked at the Barclays hedge fund index this morning, talking of the big players, and had a look at the performance over the last few years. This year's performance, they're down on average 1% so far, year to date, and we're now, nearly in May of 2016. Last year they were down, it was flat at 0%. hedge funds out there. The year before, they made 2.8%. The year before that, which way back to 2013, okay, it was 11%. But these are not those sort of figures that people think that they expect from hedge funds. Everyone, the retail traders think that all these hedge fund managers are just making huge returns year in, year out. We're not seeing that, and yet those are the realities. So, coming back to it, we're seeing these sort of figures from these hedge funds. Should they all just be packing up and going home or something? You know, these aren't the greatest of returns, are they?
Well, there's a large number of factors in there that are causing that, and some of them are to do with the global situation. A few years ago, you know, you could pretty much open up a hedge fund, buy a few bonds, take your 2 and 20, you know, arbitrage the spread and go on holiday. You know, certainly go to lunch and go on holiday. That's all ended. You know, back in pre-2008, you had the guys in America, Cornwall Capital, Scion Capital and the like, who were making huge bets against the subprime market. I'm not particularly aware of another opportunity like that where you can put on an asymmetric bet, you know, buy some insurance for a few $100 million a year and, you know, make 80, 100, 600 million out of doing that because a bond has collapsed. I could be wrong. There's probably some other bubble somewhere that's bubbling up. It's just not visible to us at the moment unless we're right on the inside. So all of that kind of stuff has ended. There's also an awful over-reliance on mathiness going on in these hedge funds. So a lot of statistical analysis is being done. And certainly from my experience watching over these guys' shoulders, you'll find themselves tying themselves in knots with some of this statistical stuff. And as a kind of an experienced trader, you can look over the top and think, well, hang on a second, you're trying to write an algo to work that out and try and end up with a superior performance when actually, you know, that's going to take you a month to do that, and then there's maybe 6 weeks to get it programmed up, and then you've got to back test it, and you've got to do all that kind of stuff. And by which time the market conditions have changed, why didn't you just discretionary trade it because it was a good idea? And when you look at it, they're not doing very much different to we're not doing anything different to us. They're still looking at, you know, common patterns that you and I would see: support, resistance, you know, double bottoms, double tops, head and shoulders, all of the usual things that we would see. So you've got this kind of shift from these big asymmetric bets over to much more kind of mathiness going on. Again, you know, I'll make that caveat that I'm generalizing hugely, but you kind of see the shift in that going on. There's an awful lot of banks and hedge funds have spent an awful lot of money on tech, and that is actually costing them money. But having spent that money on tech, there's this kind of sunk cost bias that goes on. You know, certainly if you're in a bank, you can't go to, you know, if you're a senior guy in a bank, you can't go to your next banking conference and say, well, actually, all of my quants and my techies are not actually very good. And really, if I was really smart, I'd kind of get rid of them and go back to hiring some discretionary traders because actually they're going to work out cheaper. You've got to go through and say, no, we've got the best quants and the best techies, because that's what you tell your clients. And you can't roll back from that. And worse than that, you can't pitch up to your shareholders and investors and say, actually, I made a mistake. I've spent all this money on quants and techs, and they're only producing, you know, 3% or minus 3%. And actually, I can't see when they're not going to produce that, because actually the world conditions is we've got negative interest rates, and all those carry trades that I used to do, they used to make me money, I don't do anymore. I can't see any massive asymmetric bets on bonds or something.
Well, let's actually stop this. This is the end of we're coming up to the end of part one, John. We'll stop it here. We'll come back for part two, and we'll carry on where John sees automation very shortly.